Mark, we're the final. I won't say best for last, but you can think it. That'd be okay. And so welcome, everyone. What a great couple of days of discussion. So hopefully we will end strong and have a great conversation. So I won't spend time introducing our panelists. I'll let them introduce themselves and then just make note that the bios are all available in the app, and certainly will all be available after the session for further conversation. So I will start and let the panelists really introduce themselves. So what makes sense, we'll start at the end and work our way closer.
Sure, thank you. Thank you, Allison. My name is Nalini Foyle, and I am the Director responsible of investment at BMO Global Asset Management based in Toronto. I come from an organization who's been working in this space for a very long time. BMO Global Asset Management is quite a global organization, and we have offices in Hong Kong, London, and New York. And through acquisitions over the year, I can say we have a pretty robust history in this space. I'm part of a larger team at BMO Global Asset Management of about 17 dedicated professionals focusing on kind of good governance, ESG integration, engagement, and collectively the 17 of us work both internally with investment teams and externally with clients as well on active ownership. So happy to be here today. Over to you.
Thank you all. My name is Lisa Pathani. I'm the manager of ESG engagement at Chevron, and I have to update my LinkedIn account, I think, because the agenda on the side there is still a little outdated. Been at Chevron about 5.5 years, and Chevron established an ESG engagement team in early 2018 when our new CEO, Mike Worth, took over. At the time, it was very apparent that we were getting many more ESG-related questions from our different investor groups, particularly in our passive investors. And so our CFO at the time, Pat Yarrington, recognized the need to have a centralized team that was more strategic about engaging with our investors as well as other stakeholders on these issues. So we had the ESG team established. We started with 2, and we're up to about 8 people now on the team. And we work very closely with our IR team. I tend to go on a number of roadshows with them and work with our investors. So a number of you and I have met over the past 2 years, and we continue to meet with other stakeholders. And I think one of the most surprising parts of the job in talking to our stakeholders, the ones that have been really active, are our employees. They want to understand more about how Chevron is positioned to deal with the energy transition, and we'll talk about that as we get into the questions.
Great, thank you. And Mark, pass it over to you, and I think you have a few slides, correct?
Yeah.
Great.
So I'm Mark Campanelli. I'm the founder of the Carbon Tracker Initiative, and we're a financial think tank. We're non-profit. We're funded by foundations, so we don't have clients or analysis is available for free. We're primarily ex-City of London or Wall Street oil and gas analysts and mining analysts, utility analysts, and people who cover regulatory affairs, and people who use our data, people who are concerned about modeling capital expenditure associated with projects that may or may not meet the goals of the Paris Agreement. So I do have some slides. I want to address some key points. Where we stand today, we've got the highest concentration of carbon dioxide that the Earth has seen for certainly hundreds of thousands of years. That's all happened in the last 50 years. At the current pace of emissions, we are completely misaligned with the goals of well below 2 degrees. Now, what I want to do from some of the points that I look at 3 concepts: the carbon budget. I then want to get into the stranded assets argument and Paris alignment. There's a finite limit to how much more carbon dioxide we can put into the atmosphere. Let's be clear, climate is not an ESG risk issue for oil and gas companies. It's a fundamental business risk issue. It's a survivability issue. Is this business viable in any sense of the words as an investor? And looking at what we have studied, we model all the future capital expenditure. It's quite clear that companies raise the risk of destroying shareholder value by developing pathways which are non-Paris aligned. And despite the rhetoric, most of the oil and gas industry continues to invest billions, tens of billions, hundreds of billions in expanding the industry. I've got to have a shout out for Repsol, which is a marked change in the last 48 hours. $5 billion asset write-down. We should come back and talk about that and what that means for the rest of the sector. I just want to go into some of the stuff that carbon trackers associated with the carbon bubble. There's too much data on this for you to be drawn to. The top right is 41 gigatons of carbon dioxide emitted each year. The little circles of the white, the blue, and the red is if you want to have a 66% chance of avoiding, say, 1.75 degrees or 1.5 degrees, we've only got 9 years left before we break through the 1.5 degrees, and 18 years left before we go through 1.75 degrees. We've not seen those temperature ranges for 20,000 years. 2 degrees, we've not seen that for millions of years. You have to go back something like 50 million years before you see those kinds of temperature rises. And based on current emission trajectories, we'd go through that within the lifetimes of quite a few people in this room. Doesn't mean that we'll experience those temperature rises, it means that we'll lock in. And the numbers of people I meet that think that once you've melted the Arctic, you can refreeze it by taking CO2 out of the atmosphere. Is this credible? We hear from people, don't we? So that's the data. How have things gone since Carbon Tracker published our first report in 2011? What this shows you is the proven reserves of coal. That's what the red lines are. And then the blue is gas and oil. And there's little bars along the bottom. The lowest one is your 1.5, and the one above it is 2. So it's and it's falling each year as the carbon budget declines because of this 41 gigatons of emissions. It simply makes a point, and it's an obvious one, that there's far more proven reserves of coal, oil and gas out there than can possibly be burned to stay within the goals of the Paris Agreement. And that includes a lot of the gas and a lot of the oil. So this idea that there's a switch to gas, we've got to question that. There is no switch to gas if we have any intention of meeting the goals of the Paris Agreement. So what are corporations planning for? In my view, what we're seeing from most of the industry is, in the context of, say, they'll spend $1 billion a year on renewables, they're spending $20 billion a year on traditional oil and gas, is that they're planning for failure. There's no other way of describing it. Most of the scenarios that we're seeing from the expert energy teams across the board are forecasting very dramatic increases in the use of oil and gas. It was only 3 years ago that OPEC forecast a 50% increase in the use of oil and gas. Most of the majors are forecasting a 20% growth in demand for oil and gas. And look at those steep pathways that we have to get down to get to net zero carbon. So where that leads to, if you're an investor, you have to then analyze the capital expenditure associated with these companies, and you have to look at which projects. So what we do at Carbon Tracker is we use Rystad energy data to model all the capital expenditure of all the oil and gas majors to work out which projects are not Paris aligned. And the rhetoric we're getting from a few years ago was Ben Burden's famous stranded reserves due to climate change not likely. And his most recent one is that we've got no choice but to invest in this future production to meet the demand that they believe is set out in their forecasts. And so what this is a pathway, I think, to challenge the viability. Carbon Tracker produces analytics to go into that. And you can download this. We do this in association with the PRI, is to look at these particular projects. So I just want to park on this briefly. How do we work out which companies are not Paris aligned? So what this is, you'll be familiar with this. This is a cost curve. You can model every oil and gas project against a cost curve. So the lowest cost projects on the bottom left, the highest cost projects on the top right. So we can test against an oil price. Here it's been tested against $70 a barrel. And what you'll see is a lot of those projects are not viable at $70 a barrel. If you want to be making money in this industry, you've got to be right at the bottom left of that cost curve, which is why Aramco is arguably going to be one of those last man standing. But that allows us to overlay on top of it this. So how do you work out which projects are outside the Paris Agreement? So you'll see from there that we work out which projects take you to 2.75, which ones take you to 1.75, and which projects get you to 1.6. Is anybody in this room thinking we're going to 1.5? Because if you do, there are no projects anywhere that are viable at 1.5. They're all right down at the bottom, on the bottom left, essentially, if you want 1.5. So we've kind of put the cutoff point at 1.6, and that then allows us to look at each project, each company. And this is the capital expenditure. We've discovered that just in the last year or two, the oil and gas majors are spending $50 billion on projects that are completely outside of the goals of the Paris Agreement. This is shareholder funds. There's a question mark about what these companies are doing. You can download this off our website or the PRI's website, and then you can get into the detail. I'll stop there. I think what essentially making the point is that the idea that every company is going to be a winner is not true. If you're a shareholder, you want to know in your portfolio who's winning and who's losing. This is a very simple and I think economically justifiable way of working out who the winners and losers are, and we can name the projects and we can name the companies, and we can get into the detail of the discussion.
I'm glad you brought that up, Mark, in the sense that we talked about the fact that there are going to be winners and losers in the industry, so I'm glad that one of the first points I could agree with Mark on. What Mark didn't include, though, in his slides is, I think, an important picture that the IEA has in its World Energy Outlook, and it talks about an SDS scenario in 2040 where oil and gas is still required as part of the world's energy demand. And so we can't look at the picture of the world's energy as something that is going to turn off immediately, but it's a transition, and it is smart to think about which companies are best positioned to make that transition. And in my role at Chevron, I can share with you why we think we are a well-positioned company to navigate the energy transition. Talked about the existence of my team. We also have an energy transitions team. And again, we're really trying to organize ourselves in Chevron to deal with the challenges. And we work very closely with this energy transitions team. We took a number of our experts that were spread out in our HES group and our corporate affairs group and our strat planning to put them in one place so that it could identify different scenarios, think through the different challenges, and position Chevron to navigate that. And so when I talk about navigating it, I think one of the most important steps we've made in the past year is setting up some metrics related to greenhouse gas intensity. And again, this is a conversation I have with a number of our investors. You really have to unpack what the metrics are that different companies are doing so that they are prepared for a different future. At Chevron, we tend to be extremely thoughtful, which sometimes makes us a little slower in announcing things, but I feel like what we do announce makes a lot of sense. Our recent announcements related to metrics on greenhouse gas, we have 4. We have a metric related to methane, flaring, oil, and gas. And it's important because we did this on a commodity basis because each of these are used in different ways. They're done on an intensity basis to deal with the fact that there are different sizes of companies as well as different portfolios. And we focused on equity, and we think that's a very important aspect of the metrics. Again, when you talk about equity, you're talking about the assets for which you have a financial interest. As a financial community, you're talking about your equity basis and your reporting, and you're going to be asked to report your carbon intensity on an equity basis. A number of metrics of our peers are done on an operated basis. And so we're working closely with other groups to try to bring everyone in the line so that we can have a more standardized way of presenting the equity.
Great, thank you. Thank you, both of you. Already there's so much to talk about. So thinking at more of a, perhaps starting at the top, at a more macroeconomic level, the reality is that energy will be a key driver towards any sustainable development agenda. And that the world, as it gets hotter, and the world as it gets more crowded, the energy needs will continue to increase. And so I just want to ask all of you, or each of you, to maybe share with us how are we able to think about a low carbon economy and decoupling the idea of energy use being linked to economic growth.
So we think it's possible to do. I think in the past we've seen that emissions growth has been decoupled from economic growth. And so I think it's very possible to achieve both, to keep it short.
Agreed. I think, again, looking at the World Energy Outlook report, they talk about the fact that we need to focus on efficiency, and that to meet the targets that Mark highlighted for you, efficiency is going to be one of the most important tools to work on that. And in terms of Chevron's work on this, our contribution to that is lowering our carbon intensity of our assets. We're using marginal abatement cost curves, MAC curves, to identify the most cost-efficient places where we can make those efficiency gains.
Carbon intensity targets are completely misleading. The reason why is that you can grow your overall production, but if you put more gas in it, you can say it's less carbon intensive, but you could double your sales.
And that's why it's
now,
really...
now it's, what we haven't took is absolute reductions. And in the case of every oil major, that has to mean the write-down of projects which are not viable under a 2-degree scenario, or below 2-degree scenario. Can I just ask, just as a matter, now that Repsol has announced that it's writing down its assets of projects outside the Paris Agreement, are your accountants going to be applying similar impairment tests to your portfolio projects?
I have to go back to San Ramon and talk to everyone. It's been, I will give Repsol credit for making a very ambitious statement. It's not clear so far how they're going to meet the targets. They talk about 70% of the reductions could come from existing technologies, but they don't explain the cost of those technologies. And so there's still a lot remain to be seen. And in terms of offsets that they, I imagine, are going to be using as well, right now there's a lot of discussion about Article 6 of the Paris Agreement and how countries are going to allow transfers of offsets. So I think there's still a lot of challenges that are being worked out.
Yeah.
But I also wanted to make the point, though, you raised the fact that, you know, intensity targets are problematic. That's why we broke it up into the commodities, because if you only said we're going to do an intensity target around oil and gas together, if you just shift your portfolio from oil to gas, you might be meeting your target. And we don't think that's the most honest way to go about trying to reduce the intensity. It's an energy in, energy out approach that we think is the right way to go.
I think the key thing that they've done is take responsibility for Scope 3 emissions, which means that they're offsetting the emissions from their products, and that's something we would welcome all companies doing. But your question was really about the economic growth and decoupling. I mean, in some respects, now that it's cheaper to build renewables with storage than to build gas-fired power stations, and the return and the cost per megawatt hour of producing that energy is falling in the case of renewables. You've got to transport vast amounts of gas from one side, or wherever you're locating it, to the other with pipelines or whether it's tankers, when actually you can put your energy in situ. I think the economics is now against the incumbents, and then what we'll see over the next 10, 15 years is the rapid adoption of clean energy technologies, which will help with economic growth, new jobs and growth. So the other key metric is what proportion of a company's capex is associated with renewables. So the other thing we saw from Repsol is huge announcements of investments into renewables as a percentage of overall capex. I mean, would you accept that that is a reasonable metric?